Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Bob Lang, founder of Explosive Options, to discuss why there's high complacency in the market and why traders should always be having puts in their position and working that within their portfolio. Bob, it's great to see you as always. Welcome back to Trade Talks.
Great to be with you, Jill. Thank you for having me.
You got it. This summer was interesting. It felt like volatility was exceptionally low. Do you think that there is more complacency in the market that may be warranted?
Yeah, I mean, apparently people are convinced that the Fed is done with rate hikes, or if they're not done with rate hikes, there's going to be cutting rates very, very soon. And I think that complacency there, that obvious low VIX and 13%, we closed at 1306 on Friday. And of course, being in front of a holiday weekend, we often see volatility selling off in front of that holiday, and then all of a sudden it gets quote unquote paid back right after the holiday is over. So that would be today or maybe even tomorrow. But still, I think that people are a little bit too let's just say they're over their skis right now and trying to figure out what the Fed is trying to do with interest rates. And I think as we move along here and we get more data, more information, and that's of course what the Fed has been telling us all along. They're looking at the data. We're going to find out a little bit more about where monetary policy is going to be going.
Yeah, and it also seems as if the equity and bond markets are telling two very different types of stories. And Bob, as you know, if history is any guide, it doesn't just happen in 9 to 12 months. It will take a good 18 to 24 months for Fed policy to play out, especially since many of their data indicators are lagging, right? So to think that they're going to potentially cut this year or make any sort of pivot, I don't think they've been telegraphing that at all. No,
absolutely not. And good point you brought up about a lag and the data, because the jobs data, which actually came out fairly benign last week, and we saw a rise in the unemployment rate, there's a huge lag in the data when it comes to impacting the economy. And then of course the stock market is trying to figure that differential out as well too. We often know that the market is a forward-looking mechanism. It's a discounting mechanism that looks forward about 6 to 8 months. Well, we have about a 6 to 8 month lag period when it comes to the jobs market. It's the jobs market here that has been bothering the Fed the most, because it's been a very, very tight job market. And when the job market is very tight like this, we see labor costs starting to increase. And B, wages across the board have been higher than inflation and actually been increasing inflation. What do companies have to do? When they have to pay more money on wages, they have to raise prices as well too, at the margin. So in order to keep the investors of their companies satisfied as well too. So it's a very fine line. I hate to use another analogy here. It's a very fine threaded needle here that the Fed has to come by here. But as far as the jobs data is concerned and the data and so forth, you're absolutely correct when it comes to lag periods. So trying to figure that out is a little bit more tricky.
Bob, let's switch gears and talk about technicals for a moment here. I know you use McClellan oscillators in your work. What are they indicating in terms of overbought levels?
Well, as of Friday, Jill, we were pretty well overbought, and not to an extreme level, but a moderate overbought here. And we're giving it a little bit back today. And of course, the Russell 2000 has been the one culprit today for guiding markets a bit lower here. And of course, the VIX is what I mentioned earlier in our talk here. But I think that right now with volatility where it is and so low, McClellan oscillator still positive, but coming off of the overbought readings right now, I think that's telling us a lot in terms of demand for stocks right now. We did have a really, really poor amount of days in August, with breadth just negative almost every single day, for the exception of this last week of August, where things sort of turned around a little bit. We did have a buy signal occur on the breadth last week. So that's a positive. And as long as the McClellan oscillator, which as you talked about, stays above zero, I think we're going to be in good shape.
Let's put all this together, right? So we have macro, we have Fed, we spoke about some fundamentals, we have some technicals in there as well. Why do you think that traders should always have puts working in their portfolios at this point? I think I'd rather buy some insurance at 13 versus that pop that you can get when you have a low VIX. That pop is a little bit more extreme.
That's exactly right. Now, the VIX is what is it portraying? It's portraying volatility 30 days out, and the anticipation of where the markets are going to go 30 days out. When VIX is at 12 or 13%, the anticipation is the market's only going to go up less than 1%. So actually move up or down 1%. So it's cheap to have those puts on just in case something happens. We always know that there's going to be those days, Jill, where the markets are going to get slaughtered, are going to get hammered in one day. Whether it's one day or whether it spills over to 2 or 3 days, that can be a real painful experience if you're just long only. So if you have long puts and you have long calls, you're offsetting a lot of that volatility, and you're going to lose a lot less money than you would otherwise when the markets are coming down. Look, we all like the markets to go up, right? We're all bullish. We all want to see the markets go higher. We all want to see our accounts increase. But we know that in reality, that doesn't work every single time. And you have to protect yourself against that downside.
All right, Bob, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.